Our innovation platforms are all technologically enabled, which means they follow learning curves. And learning curves are expressed or characterized by cost declines. So they're very deflationary, but it's a good deflation. So the first characteristic is learning curves, cost declines. If you've heard of Wright's Law is a relative. We've centered our research on that. And we can figure out how quickly costs will fall and how much demand is likely to take off as more and more sectors gain access to these technologies. So that's the first. The second is that these technologies or the platforms scale across sectors. So we've set up our research at ARC very differently from traditional asset management. Our analyst responsibilities are broken out by technology, and there are 14 different technologies involved in the 5 innovation platforms. So they are tech specialists and sector generalists. It's the flip side of how research is organized traditionally. And then the third characteristic is they are launching pads for new innovation. So in the case of what we now call multi-omic screening, used to call it genomic screening, if we had not figured out DNA sequencing specifically so that we could analyze the 6 billion bits of code in our genomes, we would never have been able to isolate mutations. Mutations are the earliest manifestation of disease. So that was sequencing. And because of that, an innovation called gene editing was possible. If you can isolate a mutation, you can reprogram it, edit it out. So we're seeing incredible results, cures for disease. And we think that's going to become a big theme in the years ahead.
So one of the pieces of this thematic investing that you're doing that I don't think people quite understand is that historically where that money came from and how the actual funding occurred wasn't in a traditional model. So venture capital, as one example, is kind of this milestone-based funding where somebody would say, hey, I'll give you a little bit of money.
Private is, of course, the venture capital. And because of our tax laws here in the United States and the preferential treatment for private equity and carried interest specifically, venture capital has really become isolated, I would say, to those with very high incomes or assets, and the little guy or the average investor, or even some foundations and institutions cannot get into these deals. It's a very small circle here. And so we're trying to do there what we did in the ETF space. In the ETF space, we turned what was a passive wrapper is just how you deliver a fund, called the ETF, into an active wrapper. And most people thought we were crazy, which I love. I love when people think we're crazy if we're onto something. And so at first we were, again, ignored by the industry. And now everyone, 9 years later, understands this is the better model for the end customer. In the private world, what we're doing is we're taking something called an interval fund. And an interval fund, that concept, evolved in the 90s, believe it or not, just like the ETFs. And here the SEC was trying to give individual investors access to private deals. Now, why didn't that happen? Well, it did not happen because of the preferential tax treatment for this accredited investor strategy. So we cannot charge carried interest, and we don't want to. And this is greenfield. For $500, a person can gain access to our public-private ARC Venture Fund. Public-private, we've done it that way, and it'll evolve to 75% private, 25% public, because we want liquidity for quarterly withdrawals. Just like REITs have, quarterly withdrawals up to 5% of NAV, that's what we will have, and we need that public market liquidity in order to provide that. So it's a much better vehicle than venture capital. First of all, you're not locked up for 7 to 10 years. You can get in with $500. You can inflow daily or average in if you want. And really what we're trying to do here is democratize venture capital investing. And we want to increase the allocation of capital to private companies, which are where the innovation starts. That's right. And I'd also like to say in the public markets what's happened, and I'm on my soapbox here, so we've had this shift towards passive investing because of the tech and telecom bust, and even more so after the 08-09 meltdown. Asset managers have been thinking more about career risk and business risk after those two massive dislocations. And so the pendulum shift towards passive has been extreme. I think it constitutes the most massive misallocation of capital in history. And the reason I say that, and the reason I started ARC, is because we have never been in a period before where 5 innovation platforms, you mentioned them, the multi-omics sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. We've never seen 5 innovation platforms evolve at the same time. The closest we've come is to the early 1900s, telephone, electricity, and automobile. So the irony here is because of the tech and telecom bust, that's how this all started. There is a fear of technology. There's a new technology, early stage technology. There's a fear of volatility. People forget that volatility, it doesn't feel good on the downside, but boy, is it nice on the upside. And so we are trying to change that pendulum, at least be a part of it, shifting back to active management, because there are so many opportunities, and we actually think the risks for those who are thinking about career and business risk, the risks today, we believe, are more in the traditional benchmarks, which represent the traditional world order and safety, tried as true. Well, if there are 5 major platforms evolving at the same time, the most provocative of which is artificial intelligence, the breakthroughs we're seeing are astounding us, and all we focus on is innovation. We're seeing breakthroughs today that we did not expect for 5 to 10 years. And finally, with ChatGPT, we may be, we have captured the imagination of the general public. But as we're talking to prospective investors, there's still this fear, like, oh no, so it's a very interesting time. This is not like the tech and telecom bubble. In fact, it's the opposite. The tech and telecom bubble happened because of the internet. There was this, again, capturing the imagination of the public. What, the internet? Wow, look at what this is going to allow. And then investors started throwing capital at eyeballs. That was the valuation metric. How many potential eyeballs can this website garner in the next 5 to 10 years? So that was too much capital, chasing too few opportunities too soon. The technologies were not ready. And even if they were close to ready, the costs were prohibitive. So to give you a couple of examples there, DNA sequencing cost for one person's genome, and forgive me if you've heard this, but it is the most provocative example here. It cost in 2003, when the first genome was pretty much finished, we've completed it now, it cost $2.7 billion and took 13 years of computing power for one person's genome. Remember that 6 billion bits of code. Today it costs $200 and can take a few hours. So we are all going to have our genomes sequenced regularly. And we're all going to have geneticists, because I'm going to go back to those mutations. As we age, more mutations occur, and we need to figure those out so that we can edit them, program them out of the system. So the costs are low enough now, that's an example, and the technologies are ready. So if you think about the cloud, it really didn't happen until it was a figment of the imagination, but it didn't happen. We didn't have the technology until AWS in 2006. We didn't have the first really big breakthrough in AI, deep learning, until 2012. And really the transformer architecture in AI until 2017-18. And that's why we now have ChatGPT. We're known for our social media and social marketing strategies. We give our research away happily. We are now giving more and more of our models away, starting with Tesla, because they are so misunderstood. And because our analysts, given their domain expertise, have been disparaged by the traditional asset management world, where most have MBAs. We do not want MBAs. We do in terms of managing our business, but in terms of investing, we don't want. We think domain expertise is going to be much more important, given what we do. So, added to social media and social marketing, we have now a social distribution strategy. So Titan, which is an Andreessen Horowitz funded company, is an app that now is featuring our interval fund. And what has been astounding to us is every day, no matter what the market was doing, we have had inflows every day. Now, slow but sure. And so I think that the individual investor out there understands, in many ways, more than a lot of institutions, how much is changing, how the ground is shifting underneath our feet, and they're not finding the companies they want in the traditional financial world. So volatility, yes, volatility, many people think that is a measure of risk. It is not a measure of risk per se. It is in one sense, in that it is more a function of uncertainty. And when we move into a risk-off period, as we've been in for the last 18 months plus, the time horizons, investor time horizons shrink. And in fact, what I found most interesting about the last 18 months is our strategies were very much out of favor. They are coming back into favor, and we can talk about why in a moment, but very much out of favor because of fears of inflation and interest rates and the actuality of both of them going up. Long duration assets, so very long-term oriented assets, are going to be punished when interest rates go up, especially at the rate they went up over the last 2 years. We are up, I think, somewhere between 18 and 20-fold in terms of the Fed funds rate. That has never happened in history. What also never happened in history was that the bond market, which was the refuge for those fearing volatility and risk, had the worst performance. I think this was true through the end of the year. I know it was true through the end of the third quarter. The worst quarter in history, unless you go back to the 1700s. So that was one long duration asset, and that actually has income associated with it. Our strategy, which tends not to, we tend not to pay dividends. Our companies don't. They're reinvesting in their companies in order to, really gain exposure to exponential growth trajectories, which is what we want them to do. So our strategy is no income. We're going to be treated much worse than bonds. And so this idea of volatility, just to give you a sense of this, the realities that we faced and that we want investors to understand. Pre-COVID, as we were beginning to understand what a disaster this was going to be, there was a 1-month period where the market, depending on the measure, went down 25 to 30%, just in 1 month. We were down, our flagship was down 46%, more volatile as the uncertainty kicked up. Then, because our mantra, one of them is innovation solves problems. Why are they selling? And of course, the reason they were selling our stocks is because our company's cash flows, again, as I just said, are not going to the investor right away. They're being reinvested to make this new world happen. And so investors don't like that when they have a short-term time horizon. And they sold us. And I said, wait a minute, who do you think is going to solve this COVID problem? It's our companies. And we called them at the time genomics companies, were the most punished of all because many had negative cash flow and not very large cash positions. And so some of them were down 75 to 80% within 1 month, just to give you a sense of what we were dealing with. Then April of 20, the market bottoms. And from the April of 20 to February of 21, everybody began to understand, yes, our companies are going to develop the vaccine, the tests, they're sequencing the virus, and so forth.